This is the Daily Market Rundown live from the Tradelo trading floor. It's June the 2nd. Some highlights from today's show. China accuses the US of breaking the deal. Waller says rate cuts are coming despite tariffs. And US 30-year bonds are sending a very important signal. Good day traders, and welcome to the June trading month. It's likely to be a very, very interesting month. There's a number of things that of course are likely to drive markets over the course of the next month, starting of course with this week, as there are a number of key hard data points incoming this week. And of course we'll be discussing those over the course of the week during the Daily Market Rundown. With that in mind, let's get stuck straight into it because there's quite a bit of news flow over the weekend to talk about. Now I'm not going to go through everything because obviously there's a number of things you can cover, but we obviously had OPEC coming up with the supply increase, which was mostly expected. We also had, of course, the Ukraine attack inside Russia, which is interesting, and no doubt we are going to learn a lot more about the implications of that attack over the course of this week. So, markets will be very closely just observing what does go on there. Is there likely to be some escalation or some form of a retaliation attack? So again, a lot can happen there. Does it matter for the broader markets? Perhaps not. Of course, we could have a very aggressive retaliatory strike, which includes some form of nuclear. That, of course, will perhaps create some significant risk off as a result of the idea that it does then bring NATO right back into the equation. And of course, we do have the ongoing talks this week between Russia and Ukraine. So that'll be very, very closely watched. There's a number of things that can come from that. The key takeaway is that there's a lot of news flow likely to come from that. There's also a lot of news flow likely to come from the tariff situation. Now, in the last couple of days, if you go back to last week, we of course first had the US accusing China of backtracking on the Geneva deal. And now the Chinese have come out and said the US is backtracking on the Geneva deal. In essence, what this is all about is the US is accusing China of sort of slow tracking the sort of export of key minerals. Of course, some of the new guidelines that are coming out on AI chip export controls, as well as chip design software sales to China. So there's just a number of sort of almost not necessarily tariff related type sort of escalation going on, but more sort of secondary type escalation that's going on in the background. And it doesn't really point to a situation at which we suddenly going to see a significant amount more trade done between the China and the US. Now, the important thing to take away is that there is this idea in the market that there is a call going to be held this week. Okay, I think this is perhaps one of the key headline, focus points for us day traders this week. Is the Trump call is expected to go ahead, but I wouldn't be surprised if this does get cancelled. We of course see some sort of a truth, a tweet or whatever you call a truth. I don't know what the verb is, but let's say a truth comes out from Trump where he says, all deals off, I'm not going to talk to Xi Jinping unless they do this or that. So the point is, I suspect we're going to get some form of escalatory type scenario this week. And of course, we know the whole taco thing now where Trump always backs down. So again, whether he chickens out or not, the point I want to stress here is that the tariff situation is now becoming a secondary concern for markets. Okay, that has been the case not just today, it's been the case for the last couple of weeks. We can see the markets have desensitized to the whole tariff situation. Just last week, of course, we had the US impose 50% tariffs on Europe, and the markets barely budged on it. And of course, by Monday, it had already been withdrawn. Okay, the point is that the markets are not so focused on the tariffs right now, but in fact, the markets are now going to turn their attention squarely onto the situation with the hard data, and that's key for this week. I think if you ask me in terms of the importance of this week, it's probably going to rank as one of the most important weeks, simply because it's the first time now that we're actually going to see the full effect of the tariff nightmare situation we had in April in the hard data. Okay, in other words, if that tariff situation, if the whole sort of escalatory tariff situation and the global tariff that Trump has put on the rest of the world, if that is going to have an impact on the US economy and hard data in general, we should know about it this week. We should start to see it impact the data already this week in the form of course, the JOLTS and of course the non-farm payrolls as well as the PMI data. Okay, and this matters because I suspect if that data does not come in weak this week, ultimately what it points to is a scenario where the tariff situation was simply a blip. A lot of companies perhaps paused but didn't do anything more. They didn't fire, they didn't slow down, they didn't cancel orders, they just paused. Okay, so does that mean we're going to suddenly see a drop off in terms of the US economy? No. Okay, and I think that's the key for this week. I think if the data comes in relatively solid this week, the idea of a recession is going to be squashed very quickly, and if anything, we could start to see the markets get back to work pricing in a re-acceleration of growth. Okay, I think that's a very, very important theme this week, is that if we don't get the bad data this week, I suspect this idea of a recession and slow growth is going to have to be unwound. In which case, we are, of course, going to start to see a firming up of the dollar. We are, of course, going to see the equities firm up and continue this rally to the upside. Okay. Obviously, the counter argument to that is if we do suddenly get very, very bad data, okay, we could then, of course, see those recession odds rise. So it's a pivotal week. I think it's probably one of the most important weeks now, where we're actually going to see the hard data filter into the situation and the equation, and perhaps we get a narrative shift. Okay. Now, with that in mind, I think contextually coming into this week, it's important to look at the VIX and point out two things. One, we can see that the VIX is sitting in the lower end of the range that it's been for some time now. Okay, we are, of course, right back to where we were sort of when those whole tariff situation began. If we look at that 50-day average, which is that little moving average there, we can see it still sits pretty elevated. Okay, and 19 or 20 on the VIX is still a relatively elevated level. Now, that is for good reason, which is there is still quite a significant degree of uncertainty, whether that's the tariff situation, whether that's, of course, the ongoing sort of aggression going on now within Russia and Ukraine, whether that's the situation with the hard data that may suddenly turn and we may get a recession. Okay, there's a number of sort of concerns in the market. Now, what this points to is if those concerns start to be squashed, or perhaps they become less concerning, there is quite a lot of room for that VIX to squash in back below that 17, and that's ultimately what's going to catapult those equity markets, not just back to the highs that were made last year, but also, of course, back into record territory. Okay, we did talk about this a little bit just over a week ago, which is that wall of worry, and given the VIX is now sitting elevated at 20, there very much is a week where if the data comes in pretty good this week, we have got a very good wall of worry to climb. And don't forget, the pain trade definitely this year is still to the upside. Okay, money managers are all sitting on the sidelines. They're all waiting for a little bit more clarity, and there's still a lot of money on the sidelines that's not yet invested into this rally. Okay, now we'll talk a little bit more about that when we get onto the technicals, but let's move on to another a key sort of piece of news from Bloomberg. It's all about the Treasury traders awaiting labor data. Now, this absolutely matters. Typically speaking, if you go look at the last 2 years of bond trading, the bonds never moved until non-farm payrolls. Okay, they pretty much sat in sideways ranges until non-farm came out. Now, this matters particularly this week because, like I said, should we get really good data, of course, that does open the door to a heating economy or a hotter economy. And like I said, I think equities do bid up in that scenario. But at the same time, we are going to see those yields continue to push higher. Why? Well, contextually right now, the theme for bonds is very much this big, beautiful bill and the implications for bonds and the US economy. Okay, it's a bit like adding sort of, fuel or petrol to a fire. If we are going to get a relatively strong US economy and we're going to have a president that's happy to spend 67% debt to GDP, that is going to fuel not just a significant rally in the equity market, but also in the bond market. Okay, and if we go on and look at the charts, we can see that over the course of the last sort of 4 weeks, we can see that the Treasuries on the weekly chart are pretty much flat. Okay, in other words, we've done nothing for the last 4 weeks, and that's for good reason. The market wants to see what the state of the US economy is. Okay, and we're going to get that in the form of jolts out tomorrow, and then of course ADP on Wednesday, as well as then the non-farm payrolls on Friday. So it's a massive week for the bonds in which this holding position is going to break. Now, it can break that way, it can break that way, it all depends. Okay, right now when we go and have a look at the 30-year, which I'm going to point to in a minute, there's a very, very key signal that's being sent by the 30-year chart that we cannot ignore, and it ultimately is being driven by this new theme that is a combination, of course, the big beautiful bill in conjunction with the tariffs and of course the implications for inflation as a result of those tariffs. Now, Just as a reference point, note the 2's-10's curve. It's still sitting elevated. It's pretty much at the highest levels of the year, around 52 basis points. And again, so long as we are in a hot economy situation, a higher inflation economy, an economy where the government is happy to spend 6 to 7% debt to GDP, we are going to continue to see the steepener play out. Okay, and so long as that steepener plays out, that is going to have some form of restriction on the US economy. Okay, now again, it's not so much about the absolute level of steepening, but the speed of steepening. Okay, so if we get something similar to this that we had, of course, in late 24 start of this year, that very aggressive steepening, we also had that on Liberation Day. It's that sort of speed of steepening that does cause some very aggressive moves in the equity markets. Okay, now let's talk about that 30-year, because I think it matters a lot, particularly this week. There's two key things to take away from this 30-year, and the first is ultimately that if we go and look at the blue line here, okay, the blue line is just a 20-day moving average. We can see that has suddenly now shifted steeper. Not only has it shifted steeper, but it was also the low of last week. Okay. Now, typically, when markets are about to trend and break out, they tend to lean on the 20-day. In other words, the 20-day is a very, very good trending mechanism to lean on for a market that's trending. Okay. Now, we know that the start of this trend in the 30-year came about when we started to see the idea of this big, beautiful bull. Okay, and that has sustained itself to the upside. Moreover, if we go and have a look, the 50-day moving average has just crossed over the 100-day. Okay, now that on its own is technically not a reason just to go and buy 30-year, but it's a very strong signaling when we combine it with the fact that we held on to that 20-day moving average on a retest last week in the 30-year. Okay, now what does that mean? Well, I think it definitely means that yields are going to be ultimately moving back up towards the high of last week at some point this week. But again, it all depends on that data, and that's why contextually we need to understand the technicals, but also the fundamentals, which is, technically speaking, this chart wants to go higher. Technically, the path of least resistance is to the upside, and technically speaking, that 5-10 yield is likely to be tested again this week. However, it's very much going to depend on the eco data. Okay, now one of two things happen. Like I said, if we're going to get hot eco data this week, it is very much going to fuel this idea that the economy is not weak, growth is going to reaccelerate, demand's going to reaccelerate, higher inflation, and ultimately the need for yields to be higher, particularly in the near term. But of course, if we get that weaker data, we really, really want to watch how the 30-year bonds react, okay? Because don't forget, the 30-year bonds are linked a lot more to sort of the big picture sort of fundamentals. So if there's a concern, if we got a weak non-farm payrolls, fine. You'll see the 2-year bid, you'll see the belly of the curve bid. Why? Well, because they're interest rate sensitive, they are relatively near term, and of course, investors are going to start to put on more expectations of rate cuts. However, the 30-year ultimately is driven by big macroeconomic themes. They're not driven by near-term themes. Okay, so what we could see is a situation where the 30-year does shrug off a soft print and ultimately continue this path to the upside. So it's a massive week, and I think we've got to pay very, very close attention to that 30-year. Like I said, two key things there. We're holding that 20-day average, and ultimately we have now got that crossover of the 50 and the 100-day moving average. Okay. Also, don't forget, if you look at that purple line, one other key signaling, and it's a very, very strong signaling, and no one's pointing it out. It is the highest close on the 200-day moving average in pretty much the last 20 odd years. Okay, we're trading at 456 on the 200-day moving average, which is the highest close in a number of years. Keep an eye on this. These back-end yields are continuing the trend to the upside. Okay, now in terms of the week ahead, there is a snapshot from Bloomberg, compliments of Bloomberg for the week ahead in terms of some of the key hard data to pay attention to. It does kick off with a number of PMI data out today, and of course we have got that PMI following over on Wednesday. So PMIs around the world will happen. Keep a close eye on them. And then, of course, like I said, it's all about the labor data. Now, there is one key thing to talk about with this labor data, and it came out from Waller this morning. I think it's very, very interesting what he said in a sense of perhaps we've now gotten an inkling of an idea as to what the Fed's sort of preferred priorities. And it's come in the form of Waller talking about this idea that the Fed will look through the blip in inflation later on this year as transitory. Okay. Now, again, this is not necessarily something that should be a shock. They've done this before. Of course, when COVID came, they looked through inflation as transitory. They were wrong then. However, the fact that he's come out and he's used this word, or he's used this sort of, I support looking through any tariffs effects on near-term inflation when setting the policy rate, and he went on to say say that, I would be supporting good news rate cuts later this year. In other words, what he's leaning on is, even though he thinks inflation will be higher in the back end of the year and they will still not ultimately be at their 2% target later this year, he would be willing to cut rates even in that scenario. And I think that's fascinating, because what it's starting to suggest is this idea that, again, the Fed is very relaxed on the idea of when they get inflation back to target. If it takes them another 2 years, so be it. They are ultimately going to accept higher above inflation target inflation, but ultimately they prefer to safeguard the economy. Okay, so it almost looks like they are far willing or far more prioritizing the growth of the economy over the inflation. I think that's interesting. Again, it's the first one to say it, and I think that's why it's very interesting. Of course, we will hear from a number of Fed officials this week, so listen closely, because the last time we had this, the last time they came out and said we'll support the economy over inflation, we of course did have gold begin what is now an almighty rally. Okay, so keep a close eye on that. If they are going to reprioritize growth over inflation, I do expect gold will outperform and have a very, very strong week. Okay. Let's get to some technicals. I think let's talk a little bit about the SPY chart because it is pointing to just very, very strong technicals. There's absolutely nothing weak about the price action. Some key things to point about, if we go look back at that sort of January low, which then became sort of the first pivot point in March before we had that sort of Liberation Day sell-off. The key is that 576 level held as, of course, resistance. We gapped up above it, okay, and we gapped, and last week we can see we came and tested it and pinged straight off of it. Okay, so we've held that gap, and I think it's quite fascinating. After a significant rally that we then gap and hold the gap, it points to a lot of strength. Okay, there's absolutely nothing weak about that price action. You don't want to be fighting that tape. It is a tape that's now consolidating. Okay, we've been here for the last 4 weeks in this range, and I suspect, barring any kind of significant shift in the data this week, we could well be in this range pretty much all week until we get to that non-farms. Okay, non-farms is ultimately going to drive the near-term price action. Like I said, if that data comes in line, even just a little bit better, I do expect we are going to stage that rally to the upside. But again, the key thing to pay attention to is, what are those back-end yields doing? Okay, we can start to see the market become a little bit more sensitive towards long-dated yields, so we will, of course, need to watch that. But so long as this gap remains unfilled, ultimately, the price action, the path of least resistance, is right back towards those record high territory. Okay, we'll talk a lot about this over the course of this week because right now there's nothing really weak about this chart at all. Now, if we just go and have a look at the weekly chart and zoom in on the cash chart, I think there's a couple of key things to point out, and I want to just stress this leaning back into Q1 2022. So if we look at this period here of sort of 2022, that was of course when the Fed became quite forceful. They were quite aggressive in having to hike rates. Okay, I think 50 basis points, 75. That was the rate hike cycle that they took on. That of course created a significant turning point in the market. It was quite a degree of uncertainty because no one really knew how much they were going to ultimately hike. Once we ultimately had that hiking cycle done, we of course then began the rally in late 2023. Now keep in mind, at this point in time, 2023, the Biden administration was running a 6% deficit to GDP. Okay, and that's when we had that really significant year in 2023, which was again that very, very double-digit growth in terms of the stock market. And then again in 2024, of course, we had another significant rally of 30% in the S&P 500. Okay, all driven by 2 consecutive years of 6% deficit to GDP spending from the U.S. administration. Now, very, very important if you want to learn anything about sort of macro trading, when we do have significant spending from either the government or we have significant policy from a central bank in the form of QE or zero interest rates, all of this adds a significant amount of liquidity into the system. Okay, and this is ultimately what we have now. Is we have a scenario where, yes, we've had this tariff shock. Yes, there's a bit of concern and all these sorts of things. But in reality, we've now got a president that's talking about 6 to 7% deficit spending. Okay, not just for this year, but of course for next year. Now, if the data settles, if ultimately we don't get this sort of recession and we do actually start to see a little bit of acceleration in growth, don't be surprised to see us not just back towards those record highs, but accelerating through them. Okay, it's very, very much a scenario now where once the dust settles on the tariff situation, once the market kind of comes to accept that, okay, fine, we're going to have a 10% tariff or a 12% effective tariff, whatever it might be, once the market comes to accept that, don't be surprised to see us start to accelerate to the upside. Why? Well, because 67% deficit spending is significant for the markets. Okay, it doesn't matter how you want to cut it. It doesn't matter, what your best beliefs are. The reality is, you go back over the last couple of years. If it's the central bank intervening, if it's the government intervening, spending money, the reality is the stock market likes it, and that's all that really matters. Okay, so just keep a close eye on that. But like I said, it's a big week. It's a big week in a sense of we are now finally going to start to understand what some of the eco data is doing and what the implications are going to be for the market. So it's two things to watch out for this week. Watch the long end yields. I think that's key. That could shift the narrative. If that does start to break out above that 5, 10, and the 30 year, all bets are off. Okay, equity markets are going to struggle in that environment. But if they remain contained, if we see that move index just squash a little bit further, if we see the VIX squash a little bit further, like I said, there's a lot of money on the sidelines, and ultimately is going to be forced into this rally at some point if we don't, of course, start to move back towards the downside. Okay, well, that's a wrap for it then today. If there are any other questions, do post them in the Discord channel. If you like the channel, don't forget to subscribe, like, and of course comment. It always does help the channel. With that in mind then, of course, good luck out there today. Go manage that risk. Go make some money.